Okay, good evening. This is Ken Long from Tortoise Capital with a review of the weekend trading reports for 1st of July 2012. We've got a market that's in bullish volatile condition. It's at 51 out of 100 on the annual weekly RSI 14, so right in the middle. 97 out of 100 on the 10-day NDX, so it's overbought based on Friday's big gap up. We're going to see that big gap up creates a lot of overreaction opportunities to the south side. I would be cautious about taking those mechanically, as I'll cover when we get to the daily. Percent stretch above the 200-day moving average is up to 5.13%, which is white bullish. Slope of the 50-day moving average actually got a little bit worse from last week at minus 0.36%, so still red bearish. ADX 14 is at 16.2. That's neutral. That is a non-trending market. The good news is that whichever way it goes, there can be an extended trend in either direction based on the relative choppiness of the market in the last 6 weeks. So if it does get directional, there's time to get aboard. That's why I would say be careful about committing too early with too much. But if it does get going, then there is room for it to run. ATR percentage hovers right around 1.5% at 1.47%, which keeps it volatile. Blended monthly rebalancing this month. The 26 ETF portfolio, Treasuries, U.S. real estate, and emerging market bonds. The 13 ETF portfolio, Treasuries, real estate, and DIA, the diamonds. If you're following the 26 ETF portfolio and are concerned about the overseas bonds, I don't disagree with that. I don't think you're harmed by going with DIA. That's the next strongest ETF in the deck. And so I think that one is a reasonable 1-month substitute. The U.S. large caps have continued to be the strongest, and so holding DIA gives you a little more equity rather than emerging market bond exposure. So those rebalances are scheduled to take place on Monday. The ETF 2-note theoretical exposure, that should read 20%, pardon me. There were two of the symbols were in a buy signal. The model portfolio is still at 50% exposed, so there's no buying anyway, but that should read 20%, sorry. Okay. Moving on. Was looking for Jan and Miguel to give them congratulations on Spain winning the Euro Championship. The La Roja looked great. They played beautiful football. All right, so I've switched over to the to that BMR simple spreadsheet. It's a little bit easier to see the numbers, I think. So the 13 ETF portfolio, again, you can see it ranked 1 to 13. The moving average signals are based off of price compared to the 88 period moving average. That's a 4-month using daily values. That's a little more precise than using 13 weeks or 4 months. The two blended periods at 3-month and 6-month, that works out to 66 days and 132 days for computing the prices. Then these columns in the middle give you the percent gain since those look-back periods. And then you take 70% of the 3-month plus 30% of the 6-month, and you get the blended percentage return. Then that gets ranked 1 to N, and that's how we compute. Now you can actually see the numbers and see how close things are. A little easier to see here. And so my comment before about the toss-up between EMB and DIA, there's only a couple percentage points on the blend, and I think if you're concerned about emerging markets and bonds, then DIA is the next place to go, and that's on a buy signal. So the top 3 in the 13 ETFs, TLT, real estate, and diamonds, are all on a buy. And then you see it's the rest of the U.S., large caps, then tech, then small caps, then mid caps, and all the globals, and with Brazil, Latin America, excuse me, and globals, and then emerging markets at the bottom. If we look at 26, it's kind of the same thing. It's the bond-based ETFs near the top with TLT, emerging markets, and short-term treasuries. But then it's all the U.S. It's real estate, large caps, tech. Agriculture has finally snuck back up into the top after having been down for quite a while. That may be a function of this heat wave that is roasting us here in Kansas. Out in Norton Dam, Kansas, it's at 118 degrees this weekend. So enjoy your weather wherever you are. Yeah, so it's still dominated by the U.S. Indexes. There's small caps, financials, mid caps, and then the bottom is dominated by the international. So you get Brazil, the BRICS, Latin America, emerging markets, China, etc. So no change really from the dominant themes of the last really 4 months. Okay, moving on. Next up is the market health check. So our vertical blue lines represent 10, 20, and 30 days worth of look back. The horizontal purple lines are price targets that have been resistance levels before. So I'm looking at just about 138.5 being this cluster here, and also the top of the RAF regression channel. So that's this purple line. This purple line at 142 goes back into the end of March, which was the previous swing high that this one in May just not quite tested before it failed. The horizontal black line represents the 30-period regression line, and then the outer black lines represent the channel formed by the maximum excursion from that regression line, which happened in the first week in June here. So the movement has been away from that extreme. That's positive. Shaded blue is the 30-period Bollinger Band, plus or minus 1 standard deviation, or the river. So that dotted line in the middle is the 30 simple moving average. Thin green is the 10-period moving average. This thin red is the 50-day moving average. You can see it's still sloping down, even though the rest of the market has, on a shorter-term basis, started to pick back up. This blue pitchfork here is the Andrews pitchfork, which extends the regression channel forward about 10 days. That would give us the range of normal price behavior. If the underlying truth about the market doesn't change, it would stay in that regression channel and generally be grinding upward. The horizontal red lines are support levels that have held in the past. And you see we are just above this 5% pullback, and that represents 5% pullback from the swing high. So we're still locked into this between 0 and 10% trading range in terms of pullbacks from 142. You can see this one down here at 127 tested that 10% channel. Beyond that 10% would be considered the bear, and that's the 200-day moving average is that thick red line in the shaded red area. So you can see we're navigating here in this region between the edge of the bear and that swing high. Now the fact that this 200-day moving average is continuing to go up means that the amount of slack or wiggle room is starting to degrade, and so it's got less and less time to be able to make a move. The last 30 days, though, do look generally positive, and Friday's, I guess, relief rally that the tension about the health care was resolved, and combined with a commitment in the Euroland to bail out Spain and Italy no matter what the cost, seen as capitulation by the Germans. To me, that's just there's going to be a whole lot of printing money going on, and so I think that gold and silver just became a lot more interesting, as did food. DBA. Combine that with heat waves out here in Kansas, and that may account for some of DBA. So what we have is a series of price targets on the downside that, if it were to fail here, we'd be looking at downside targets of 136, about 133, 131-ish, 129, and 127. If it were to break through 129, a couple reasons why that'd be harsh for the market, because then it would go under its 200-day moving average. It would have failed through the bottom of the regression channel, be testing this swing low over here at 127. So that would be that's the price ladder on the downside. On the upside, we're looking next at 138.5, and then 142. Until then, we're still in a tactical trading range that favors the agile intraday trader. I want you to respect the downside, even if it's just one-day downside moves with the frog, and that is, you can see the value of that just by looking at these tall red candles. There's 1, 2, 3, 4, 5, 6, 7, 8. Those big red candles in a bull market, yeah, that's the bearish one-day move against the trend, and every one of those is a big winner in the frog. So you need to have that in your arsenal because it forces you to look at the day as it's unfolding, as opposed to the beliefs that you bring into the day. So it will give you some opportunities to trade opposite from the primary trend, if you will. For example, if we saw it open inside yesterday's or Friday's candle and then take out 135, the next target would be 133, looking to close the gap and getting back into the river with a follow-on of the Bollinger Band mean at about 132. So that's my scenario for the downside. If it breaks out above 136, then it's a quick dash up to 138.5 to test this previous resistance level at 138.5, which also coincides with the regression line channel. You can see on %R that we're into the overbought conditions now. The jaws of PPO, so the percent price oscillator, have opened to the upside after a period of pullback, so that's positive. That could support some favorable moves. And ADX, the bulls just jumped in charge again with this gap up and strong follow-through day on Friday. And ADX around 16 is low enough that it could actually begin to become trending. You can see that the last time it was trending, it got up to 35, and that was actually a negative trend, and that was caused by it was a 20-day trend that looked like this. Let's go back 40 days, and you can see the last time ADX was around 15, price was at about 140. It went from 140 down to about 127, or about an 11% adverse move. And in that time, ADX went from 15 to 35. By the time it got to 35, it was very clear that we were in a downtrend, obviously. But it's very hard for SPY to sustain an ADX stronger than 35 because there's just not that much money in the world to keep that trend going. So when it goes from 15 to 35 over the course of 20 trading days, you can see a 10 to 15% kind of a move. And here it went from 35 down to about 15, and that was a sideways choppy market, and we're just starting to emerge from that. Now, I look at this and I see a low at 127, another low at 131. It held at 131, and now is pressing the top here in this swing high at 136. So I see that as a series of higher lows and positive support and a retreat from Europe. And so we've put in enough of a sideways chop here with only one real opportunity to fail, and it rejected the failure at the 200. So I consider this still to be positive and long side with targets at 138.5 and about 142. And then the ADX suggests that there's been enough of this sideways support level in place to be able to extend that run up to 142. So I am cautiously optimistic here. You can see, though, that that's my price ladder on the downside. It doesn't take much information to cause me to flip. This is perfect trading market conditions here because you're getting volatile daily moves, lots of signal, especially on the downside, and the frog is a good way to key into that. So that's my that's the short story of what I think the market's doing. Lots of opportunities here. All right, next up, quick look at the top 10 regions of the world market model. And this should have read 20% in the theoretical model because 2, SPY and IWM are above their moving average filter, and 8 are below it, so that's 80%. And all the globals are weak, especially Latin America. And all the U.S. is strong. Right now, SPY is really knocking on the door. The Qs have been strongest for about almost 8 months, and now the SPY is almost ready to take that over. But it's still the large caps, then the small caps, then the mid caps. So it's a cautious risk on, if you will, but committed to the U.S. U.S. is still stronger than EFA. 2 weakest are Latin America and emerging markets. Next up, world market model. Most of the U.S. is above average except for mid-cap growth and small-cap value, but otherwise all above average. Treasuries, bonds, and real estate have been dominating. This is that IYR, is that U.S. real estate. Asia and Asia less Japan, below average. China still the laggard. Malaysia and Singapore still the winners. Latin America and Brazil lagging. Mexico in front. All of Europe weak. Inside the business sectors, it's still the defensive plays with staples, utilities, and healthcare above average in both the U.S. and the globals. And then the producers, materials, energy, finance, industrials, all generally below average or weaker than the defensive plays. So no real change over the last 3 months, but still continuing. Top 30 ETFs. Stubbornly, U.S. home construction, biotech, pharmaceuticals, financial preferreds. XLP, the select sector spider. We've been highlighting that one for a couple months. It's still strong. Real estate, anything with REITs is strong here, plus paying a healthy dividend. Healthcare, XLV is strong. I would expect that to continue now that we're going to dump a gazillion dollars into that on the backs of the young people. You know, that's the, I hate to be political, but you know, we're now asking the youngsters not only to pay our Social Security, but also our health care. Maybe that's why we don't teach them mathematics in high school, so they don't realize what we're doing to them. Pretty sorry. Next up is the Dow 30 using the same lens. Oops, let's get that. There we go. It's the XLPs of the world, Verizon, Disney, Walmart, Home Depot, Merck, Coca Cola. At the bottom are the producers, Hewlett Packard, Caterpillar, Cisco, McDonald's, Alcoa, Procter & Gamble. There's still that anomaly between Procter & Gamble and the Mercks of the world, Merck and Pfizer. The volatility trade up next. You can just see the beauty of VXX, which has been getting hammered, but that's okay. 9% ATR percentage. Energy at 2.21. Gold is now in 5th place on the liquidity, average daily dollar volume, and is still less volatile than the S&P. I bought some more silver bullion this weekend in the form of some coins. I just have become infatuated with the Australian kookaburras and koalas. I just think they're beautiful coins, so bought some for the kids for the safety deposit box. They've done nothing but go up in value for the numismatic value. I don't know if it's a good deal. I have no expertise in that area. I want to buy silver, and I want to buy beauty and buy things I can give to them later. So I've been buying through providentmetals.com and very satisfied with their prices, customer service, and shipping. Looking at the volatility, although we are in volatile conditions, it's because of the the increase of these of the last 200 or 300 days here. But still, by historical measures, not even very volatile. So we still have, we're not getting anywhere near extended on volatility right now. I think that's favorable for the long side. We're going to shift over to the daily now. All right, let's take a quick look at the gap stat. There hasn't really been much interesting on that until this last week. So let's check back in with it. Looking at the last 30 days, we've seen the market gap down 12 times out of the last 30. 7 of the 12 times it has continued to fail for minus 0.43%. 5 times it has reversed to close higher at 0.76. So that's sort of the morning hook trade, gap down, reverse to close higher, and that's actually been pretty lucrative compared to the continue to fail. 18 times, and this is where it gets also interesting, the gaps up have been very, of a different nature, I would say. They've gapped up 18 times. 7 out of 18 times the gap up has failed and closed at minus 1.09%. And 11 times the gap up has continued to gain for 0.71. So what I take from that is that the gap up days have been the more interesting in terms of the magnitude of the follow through in either direction. And I would expect to see some of that again on Monday as well. All the globals, which are below their 200 period moving average, all responded strongly on Friday along with the U.S. for that gap up. Now, if there is no follow-through, those are going to set up for nice failure trades. So it'll be interesting to see what happened in the overseas markets Monday morning. But they're all on the overreaction. No signals on the channeling. You can see that volatility has actually kind of stabilized in the past 10 days or so, and it's still in the volatile area. But as the what happened with it as the volatility increased. This used to be very, very volatile, almost 2 standard deviations. And then as these volatile days keep getting added and the quiet days are being dropped off near the end, the size of what is defined as normal starts to expand. So now you can see the adaptive nature of this indicator, that what used to be extremely volatile is now just simply volatile and getting ready to pull back into normal here pretty soon, which is actually a good thing. That this volatility of the past 10 days, even though high, has not resulted in further failures. It's almost like a reaction to noise, and then there was no follow-through. We have washout patterns in EWZ in Brazil. That could actually be very good if there's some global follow-throughs here, because it has fallen the most, or among the most of all the country ETFs overseas. And so on a washout pattern, that one therefore has the greatest possibility for payoff in the shortest period of time using that kind of logic from the washout. At 551 on Intel, you have a bunch of these first 5 symbols: VIX, Caterpillar, Hewlett-Packard, Procter & Gamble, and Cliffs Natural Resources, all signaling on the auto framer at better than 2 to 1, so that's positive. Moving on. Looking at the Dow Tactical. Here's that we got a washout pattern in Hewlett-Packard to consider, and a test out at 3.7. So we're going to take a look at Hewlett-Packard, HPQ. We'll take a look at EWZ on charts as well, because we don't see washout patterns all that often. And when they come around, it's good to pay attention to them. Max pain range compression number 2 is Caterpillar, and it comes in at 3.9 reward to risk, and it has a 3 on the fraud quality number, so it has some reliability in there. And its standard deviation is 73 cents. Hewlett-Packard only 25 cents. That makes it pretty interesting. Intel 3.5 on the fraud quality number and a standard deviation of only 15 cents. And his range stat is 67 cents. So there's that's where you almost get that 4 to 1 kind of a move. 2.8 on Procter & Gamble for the reward to risk ratio, and number 4. And McDonald's, I just automatically like McDonald's anyway because it's a value play. It's number 5 on the max pain range compression. Was a percent loser on Friday, so it really did not respond favorably to the good news in the market, which is a real anomaly. Looking on or moving on. Before we move on, just how to use this chart again. All these green highlights down here in the Tortoise NDX area, these are all things that closed higher than the previous look-back period's trading range. So the 10-day, 1-month, 3-month, and 6-month highs were all taken out in significant percentages. That's when these all light up green. So that was really a broad market response. For instance, if you took a look at Coca Cola, it's at 174. It's almost a full 10-day trading range above is where it closed, 174. So 75% of the previous 10 days trading range is where it closed. So that was a huge leap up. So we'll take a look at that and see what that kind of a breakout indicates. Next up is the ETF 30. Only one doji on treasuries. Here's the washout pattern on Brazil, which put in a 5% day. And then the usual suspects up here in the max pain range compression, the VIX, silver. What's pretty interesting about silver is it's number 2 in the max pain range compression, but it was up 4% on the day, on Friday. That's pretty interesting. Brazil was up 5% that day. So I'm interested in silver. Everything closed very favorably except for the VIX, and you see the high numbers here in the RSI2. They're all closing near the top of their 2-day trading range is how you read that. So, and it's just an extraordinary move. The biggest single percent mover, I think we look at Japan, and then mixed commodities finished pretty high with a 157 compared to their previous trading ranges. All right, moving on. Looking at the market mosaic. See the 30-period regression line. The R-squared is starting to increase now as it drops off some of this losing data. This slope line is going to start getting steeper if there's any kind of follow-through in this next week. The jaws of the regression line compared to its 10-period moving average are open and pushing up, but they're still just right around the 180-day average, so there's still plenty of room for this thing to go. On the percent stretch, this looks favorable. This is where it bounced off the 200 right at the zero line. And you can see the almost a head and shoulders, reverse head and shoulders here. And then if it gets above 136, this would take us up to 142 to test that percent stretch high up in here. So there's still room for 5 to 6% gains before we really significantly test the highs of that previous bull. That almost looks like a 50% retracement if you were a Fibonacci guy. And it's held support in here. That's a nice base. And the jaws here are up in the regression line. Look back, that's the 180-day look back. So I think this is, we're poised for an intermediate term move up. Next is the Z-scores of the regression lines. This looks favorable to me, and I'll explain why. The 90-period regression line has come down to the bottom of its normal channel. This yellow bar is plus or minus 1 standard deviation. So it's come down to its normal, and it's slowing down and starting to form the bottom, the first half of the cup, and would start moving up. The 30 has already voted decisively and gotten through its zero line. And the 10-period, you can see 1, 2, 3 higher lows, and it's starting to hook up. That looks very favorable. And then the price with respect to that 30-period river, so it was riding the lower Bollinger Band. It broke through that back into the river, found the far side pullback, higher low, and now a strong breakout. That's why I think the that move up to 141, 142 is well within reach here. So the regression lines are pointing to, yes, that the 90 period is improving, the 10 is positive, and the 30 is definitely positive. Excuse me. All right, there's nothing else on the technicals I want to look at, so we'll just shift over. Shift over to the look at a couple charts. Let's see, I wanted to look at we'll look at Coca Cola first. This was that 75% breakout from its previous 10-day trading range. Yeah. So I'm gonna, if we go back 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. And we were to draw this as its 10-day trading range. The yellow square is the 10-day period that the 10-day NDX references. Okay, and so this. The previous high at 76.5 would be a score of 100. And this number down here would get a score of 0. So that's your 0 to 100 scale. And now this close here at 78 and some change represents, with this as a score of 175, means that 3/4 of the size of that trading range gets added on top of that. That tells you the magnitude, 175. That's a huge move up. And what's really nice about Coke is that takes it well above the swing high. So on a relative basis, you can see that Coke has already taken out the last piece of resistance, whereas the market itself still has another 5 or 6% to go. So Coca Cola has much better relative strength than the rest of the market, and that's indicated by this 10-day NDX kind of a move, and then just on a simple look-back basis. So Coca-Cola, that's a good thing. So I want to demonstrate that just so you can see how that, one way to do a quick look at interesting targets there using the 10-day NDX. You don't get that by looking at percent R, for example. fact, I like that so much, I'm probably going to make a case study out of that. Next one I want to look at was, we said, was EWZ Brazil. That's a washout pattern. Perfect. All right, so when we look at the washout pattern, the first couple things we look for were based on yesterday's price action. So Thursday's price action, we look down to make sure, yeah, that was a that yesterday was oversold on a Williams percent R260, so oversold on an annual basis, correct. Oversold on a 10-day basis short term, correct. That's a god-awful color. So let's go back to blue. So oversold short term and long term. And then now we look, so that defines a swing low here. Next thing, we look at today's candle, or Friday's candle. It's check number one. It's a white candle, correct? So the high or the close is better than the low. That's good. Number two, its low was higher than the previous day's low, so it goes up to up. So that's a check mark. Then the third test is that the close was better than the high of the day before. So that's 3 checks. That makes it a washout pattern. We'd be looking to buy a breakout above 52 as soon as it gets above Friday's high. In this case, I'd be looking for a target at 54 and then also at 58 in terms of computing reward to risk ratio. But really, I think realistically 54 is a reasonable move. Now, given the fact that there was that big gap, I would, you could decide now how far away do you want to put your stop. According to the rules, you'd be putting your stop down here below the swing low. It means you're going to have a pretty small position size, but that's okay. I don't think the washout, you don't believe in that trade anyway. So having a stop below the swing low means that you got a lot of room and a relatively small position size. And now if it gets out of this basing action right here, that will turn out to be a nice move to get back up here to around 60 if the rest of the world follows along with the U.S. So that ain't all bad. A secondary thought for a trader, if you were looking intraday, you could have a stop on your initial position below the low of Friday for the intraday so that your day one position size was large, and then sell off enough so that your stop is accounts for the swing low before you get to the close. So that's another way to play it. Okay, the last one I want to look at is Hewlett-Packard. That was the other washout pattern. And it's, again, you'll notice the same thing. The first check is that it was yesterday on Friday or Thursday's price action. Oversold short term, oversold long term. And then it's a white candle, check. Friday was a white candle. Its low was higher than the previous day's low. That's a check. And then the close was higher than the previous day's high. That's the third check. So three checks. It's a washout pattern. You'd be buying it somewhere north of 2020. You'd be buying breakouts from here. I think targets up here and here are reasonable. So 22 and 21 are both within reach. The nice thing on Hewlett-Packard is it has a 15-cent standard deviation for the frog, so you could almost decide that you wanted to play this as a washout by start it off as a frog with that tight stop, after it's moved 15 cents. And then if the frog works and it looks like it's closing well, convert it back into a washout pattern with a stop down here below, looks like about 1920-ish, with the idea that you want to turn that into a swing trade. So it would be a frog plus a washout, using a frog to get into the washout in a low-risk manner. So that's an idea about how to combine swing trades with intraday strategies. Okay. So we're about 45 minutes into it, and I need to get the dogs over to the dog park before we run out of sunlight here. So I'll stop my remarks there and just open it up to a few questions. Otherwise, I will be looking forward to seeing you in the chat room on Monday. You're welcome, Lisa. Okay, I think unless there's no burning questions, I'll stop the recording.